Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Lifetech Scientific Corporation Annual Report. Lifetech Scientific Corporation is a diversified company that provides a wide range of businesses and services related to the medical industry. The company's primary focus is on developing, manufacturing, and trading interventional medical devices for cardiovascular and peripheral vascular diseases. The company operates through three main business segments: structural heart diseases business, peripheral vascular diseases business, and cardiac pacing and electrophysiology business. Its product portfolio includes a variety of medical devices such as L-Amber left atrial appendage closure systems, Sierra Flex and Sierra occluders, and Cura stent graft systems, through endovascular needle systems, delivery systems, guidewires, vena cava filters, vascular plug systems, sizing balloons, pacemakers, and snare systems. In addition to its product offerings, Lifetech Scientific Corporation is also involved in biomedical research and development, properties leasing business, and provides technical, consulting, and technology services. The company's expertise spans across various aspects of the medical industry, making it a comprehensive player in the field. Lifetech Scientific Corporation maintains a market capitalization of $8 billion, broadly in line with the industry peer group. Lifetech Scientific Corporation trades at a higher price-to-earnings ratio of 90 times and a higher price-to-book ratio of 1.96 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The balance sheet appears very conservative, with liabilities representing only 29% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. The primary drivers of revenue growth for a medical device company can be attributed to several key factors. Firstly, the increase in revenue from sales of stent grafts has been a significant contributor to overall growth. Additionally, the structural heart diseases business has experienced substantial growth, with increases ranging from 9.7% to 24%. The peripheral vascular diseases business has also seen notable growth, although there was a slight decline in one quarter. The company's expansion into new markets has also driven revenue growth, with overseas sales increasing by approximately 14.4% due to active expansion of business and effective marketing strategies. Furthermore, the development and certification of new medical device products through research and development initiatives have contributed to increased sales. Product innovation has also played a crucial role in driving sales growth through enhanced brand and product awareness. On the other hand, there are several primary drivers of revenue decline. The cardiac electrophysiology business has experienced a significant decline of 99%. The structural heart diseases business has also seen declines, with a 9.7% decrease in one quarter and a 3% overall decrease. The cardiac pacing and electrophysiology business has declined by 46%. Additionally, the Asia region, excluding mainland China and India, has experienced a decline of 7%, while India itself saw a decline of 7%. The financial performance of a company has undergone significant changes in recent times. A notable decline in net income is evident, with a staggering decrease of 46%. This substantial drop indicates that the company's bottom line has taken a hit, resulting in reduced profitability. Furthermore, profit margins have also experienced a decline, decreasing by 0.9 percentage points from 75.3% to 74.4%. This reduction in profit margins suggests that the company is struggling to maintain its pricing power and efficiency in its operations. The decrease in both net income and profit margins indicates a challenging period for the company, requiring immediate attention and strategic adjustments to regain momentum. The company's financial performance indicates a healthy trend in its operating cash flow. According to the data on page 3, the company's operating cash inflows significantly exceed its outflows, resulting in a net positive cash flow of RMB 132,108. This positive operating cash flow is further reinforced by the analysis on page 21, which concludes that the company is indeed generating positive operating cash flow. This suggests that the company's business operations are generating sufficient funds to cover its expenses and investments, indicating a strong financial position. The company's debt level has undergone a substantial change over the period under review. The data reveals that the company's financial liabilities at FVTPL have increased significantly from RMB 0 to RMB 576,779. This indicates a notable increase in the company's borrowing activities. Furthermore, the total current liabilities of the company have also seen a considerable rise, increasing from RMB 815.6 million to RMB 1,479.4 million. However, it is worth noting that there has been an increase in financial assets at FVTPL as well, rising by RMB 191.648 million. Despite these changes in debt levels, the interest expenses of the company do not appear to have undergone any significant alterations. This suggests that the company's borrowing activities may not be having a substantial impact on its bottom line. The company's financial performance varied across different segments and regions. On the positive side, the peripheral vascular diseases business stood out as a strong performer, with segment profit reaching $569,564 on page 8, and profit totaling $529,667 on page 9. Similarly, the cardiac pacing and electrophysiology business also showed impressive results, with a segment profit of $452,886. However, not all segments fared equally well. The structural heart diseases business struggled to turn a profit, recording a segment loss of $2,512 on page 8. Although there was no clear indication of poor performance on page 11, the increase in liabilities from RMB 127,440 to RMB 137,302 suggests underlying financial challenges. Management's outlook on the company's future is centered around innovation and growth. They plan to drive product innovation by exploring new materials and technologies, which will enable them to stay ahead in the market. To achieve this goal, they are making strategic investments in companies that align with their vision, such as Effector Medtech. These investments aim to not only generate revenue, but also create synergies that can benefit the company in the long run. Furthermore, management is committed to diversifying the business strategy to broaden revenue streams and reduce dependence on a single source of income. Ultimately, their goal is to create profound social value for all stakeholders, including patients, doctors, shareholders, and investors. This approach will not only drive growth, but also contribute positively to society. The company's financial strategy has been focused on retaining its earnings rather than distributing them to shareholders. According to the information provided, the company has made a conscious decision not to pay dividends to its investors. This approach suggests that the management is prioritizing growth and investment opportunities over short-term returns for shareholders. Furthermore, the company has also chosen not to engage in share buybacks, which would have involved purchasing back its own shares from the market. By not doing so, the company is maintaining a significant amount of cash on hand, allowing it to pursue strategic acquisitions or investments that can drive long-term growth and value creation for shareholders. There are concerns about inventory buildup or supply chain disruption in the company's operations. The data suggests a potential issue with inventory management, as the cost of inventories recognized as expenses increased by 8.6% from 2024 to 2025. Furthermore, the write-down on inventories decreased, indicating that the company may be holding onto more inventory than necessary. This could lead to further issues if not addressed, highlighting the need for effective inventory management strategies to mitigate potential disruptions in the supply chain. That concludes the financial summary for Lifetech Scientific Corporation. Feel free to comment below, and I will be happy to answer them when possible.